My name is Austen. I'm CEO of ASIFMA. Welcome back, and I'm really excited to have the panel that we have here on digital. As we had the earlier panel that you would have just been listening to on sustainable finance. And if you would have listened to the opening two keynotes, I think what you would have heard is that there's been two key topics in the Asia-EU Financial Forum that was held last week. And one was sustainable finance, and we talked a lot about taxonomy on the previous panel. The other has been digital, and I think these are the two big key topics that we're hearing about in the regulatory community globally at the present time. So I think without any further ado, I'm going to introduce our panelists for you today. We have a great lineup. We have Benedicte Nolens, head of the BIS Innovation Hub for the Bank for International Settlements. We have Esmond Lee, CEO, Hong Kong branch from Euroclear. We have Ceyssens, head of the Digital Finance Unit, DG FISMA. And then we have Montserrat, Farina, Global Digital Assets Policy Lead, JP Morgan Chase. So I think we'll jump right into it. And I wanted to kind of start off with the first question, and maybe I'll direct it to Benedicte to kick us off. And that is the topic we're going to talk about today is digital assets, the impact of regulatory fragmentation. Is there a path to global consistency? And if you were listening earlier on, you would have heard Naga Okasan speak out fragmentation and the challenges related to it. So I think this is very apropos for this panel. So Benedicte, I'd want to ask you the first question is, how would you regulate the different types of digital assets? So, I mean, there's multiple types. We heard a lot of talk about cryptocurrencies, digital securities, stable coins, even NFTs. And what would your rationale be for that approach for each one? And after Benedicte finishes, we'll have the same question to the other three panelists. So over to you, Benedicte.
So thank you, Mark, for having me. So and hi everyone on the panel. I think I see some familiar faces, and hopefully there are some familiar faces in the audience as well. So my personal viewpoint is that I think actually that the digital asset regulation in the last maybe 4 to 5 months is actually making positive progress. And what I mean with that is that we see a little bit more consistency in terms of, as you say, Mark, how different regulators are now treating these very different types of crypto. So you rightfully set out that there is basically the crypto assets. They're typically referred to as cryptocurrencies, but most of them are not currencies, so they're crypto assets. Then there are the stable coins, which play a payment function and therefore come much more close to the payment remit. And then beyond that, we see, for example, CBDC, which obviously is then within the central bank remit. And we see other things evolve like NFTs. So my own viewpoint was always that anything that is quite similar to a security highly likely ends up someday under securities law. And I think the securities regulators were the first to try to make that clear and to start introducing regimes. And that's now 2 or 3 years ago with the FCA. The SEC has been repeatedly saying if it's a security, it falls in their remit. And the Hong Kong SFC had a voluntary regime and is changing that to a mandatory regime. And we see across the board in different parts of the world, including Dubai, for example, regulation around crypto assets that looks much more similar to securities regulation. So typically what you're very used to. But to me, the missing link was how people deal with stable coins, because that to me is absolutely not a security, and it would be quite problematic even to fit it under securities regulation. And I think initially there was a little bit of people looking at each other and going, should it be a securities regulator because we want them to take most of the securities aspect, but then it's a payment thing, so should it be the bank regulator? And people were waiting for each other. And I think now we're at a point where it's quite clear that the stablecoin falls much closer to payment regulation, and therefore much more likely is within closer to the central bank remit. But again, it depends on the jurisdiction still. On NFTs, I think most regulators try to keep them outside their remit, but how long that will last, I don't know.
And maybe you mentioned, you brought up CBDC. So, you know, it says central bank in the name. I mean, where do you think that fits in? How does that compare to the stable coins, you know, or crypto assets for that matter?
Yeah, so I think a CBDC by design is actually a replacement of banknotes and coins if it is a retail CBDC. And if it's a wholesale CBDC, then it's intended to be a new payment infrastructure. So it will be very much similar to the current regulation around banknotes and coins, or the current approach of central banks towards creating central bank infrastructure for wholesale payment. And some central banks have broad mandates to operate, for example, RTGS systems and FPS systems. So I think there's not too much, there's probably regulatory change desired or needed, but it would be very clearly in that central banking remit. And how stablecoins compare to that, I think we still have to see how that will evolve. At some stage, of course, there was calls for them to be fully backed or that the reserves are properly audited. But at the same time, there are calls from commercial banks to want to issue stablecoins under the fractional reserve banking system. So I think we need to see how that evolves. But at least we can tell now that that is, as said, much closer to the remit of central banks and payment regulation as opposed to securities regulation.
Okay, thanks, Benedicte. And maybe I'll turn over to you, Jan. Obviously, from the European Commission point of view, I mean, you know, Benedicte's kind of outlined her views and the rationale for that. I mean, is that something that you would agree with?
Absolutely. Hello and good morning, good afternoon to everybody. Indeed, I think Benedicte really very clearly set out a bit the broad direction of travel here, and I think that is indeed a trend which I think I would say I would agree to, and I see also convergent across the globe. I mean, I think one point has to be made. I mean, when it comes then to the details and the fine print, it is not as if, let's say, payment regulation or securities regulation today was a completely convergent and globally harmonized area. Actually, is rather the opposite in a way. I mean, if you compare that, for example, to the Pittsburgh derivatives agenda, where indeed a coherent set of rules was put in place, that's not the way securities regulation, for example, has developed. And I think that's also what one simply needs to take into account. The starting point is not completely convergent and harmonized. The current systems are not completely the same. So in the implementation of those principles, there will necessarily be a certain amount of difference. And I think the challenge we have now is to try to, let's say, not get the full 100% of divergence which we have in the traditional regulatory space into the digital space, but maybe to try to move to 50-50 or to use this digital kind of move to get a greater amount of convergence. And I think I can say, at least in Europe, we already making quite a lot of let's say headwinds with that. You know that we've proposed a regulatory framework which is called MiCA, markets and crypto assets, which I think overall is much more harmonized than I think what we see in the traditional security space. Maybe just a couple of words also on the questions you asked on the approaches. I mean, Benedicte set out indeed the broad direction of travel. I think one point we note here in addition, so also in Europe, indeed, I think we start from the existing rules where they apply indeed, where something is a security, it's covered by the relevant rules. And I think we have proposed a framework for those areas where that is not the case. I think one additional point which needs to be made, I think, in this area is that, of course, the ecosystem is both quite different in terms of the actors, a bit more fragmented probably than traditional payments or maybe also securities area. And it is also an ecosystem which basically applies across this crypto universe in a way. So, I mean, while I think we have from the kind of risk and regulatory perspective, we see these divergences between, in a way, more payment, let's say, tools and instruments, and then more kind of securities tools. I think in the reality of the ecosystem, when you look at the wallet providers or many others, actually very often they're the same people. So that is, I think, where indeed on our side we said, okay, we'll have targeted rules, dedicated rules for example, backed crypto assets as opposed to unbacked. But when it comes to the ecosystem, indeed, we have a single kind of approach and a single set of harmonized rules in a way, because that is indeed also how the market is developing.
Thanks, Jan. That's really helpful. And I want to turn now to Montserrat, from JP Morgan, and from an industry perspective. I mean, you've heard from Jan, obviously, from the regulatory side, Benedicte from one of the large global institutions. Would you kind of agree with the way that they've basically explained that they kind of see the universe sort of divided from a regulatory point of view, from sort of the payment-like digital assets being regulated more by the central banks, those that are more like the securities regulated by the securities market regulator?
Hi, and good morning or good afternoon, everyone. I agree with a lot of things. I think for me, the key is applying the same activity, same risk, same regulation principle. So the way I look at it is it the same or similar to what we do today in securities markets? And if it's the same, then I don't see any reason to treat those assets differently. I know some of the market participants have provided, their views, and they think there should be a new regulator and they should be treated differently. This is not our view. And again, I would say here that the views that I'm going to express are mine and not those of JP Morgan. But I think that, the moment you have one of those assets that is structured in a way and confers rights that are similar to what we have today, it shouldn't be treated differently. And, so if that asset confers the same rights as a security, as we currently know a security, then it should be considered under the securities laws. And I think the key here to include that asset into what we do is to revise the different regulatory frameworks to make sure that they are technology neutral. So we look at the activity or we look at the asset itself, and we kind of step a little bit away from the technology that is being used to deliver that asset, because this is not the way, we look at the market today. We have financial institutions that, provide products and, conduct activities. And there's no specific regulation in terms of the activity, in terms of the technology that is used to conduct that activity. And I don't think that, this should be different in this case. It should be treated the same. And then when I look at stablecoins, I know a lot of people talk about stablecoins that are being used for payments. I look at them in a slightly different way, because if you actually look at the stablecoins that are in the market today, they're not really used for payments that much. They are used for other purposes, and particularly, to enable the crypto ecosystem. So the way I look at stablecoins and the way I differentiate them, again, I look at the structuring and I look at the rights that they confer. And I see sort of two types. One that for me is sort of akin to deposits, with same expectations also from the holders as deposit holders, and others that are more like an investment. So in the first case, I agree with the approach, for example, of the President's Working Group in the US that basically says that in those cases, they need to be issued by insured depository institutions because of what I said before, right? That the rights and the expectations are the same as a deposit holder. But in those where I don't expect par value, and what is more like an investment, I think the MMF regulation as a base is more appropriate. So it kind of depends on the type, and I don't think that all of them should be treated the same. And then for cryptocurrencies, I kind of a little bit of the same. I look again at, well, how are they structured? What are they conferring? Are the buyers sufficiently aware of the product itself and the rights that it confers, and also of the risks? And then, so I think proper disclosures are very important, kind of disclosures more of a on layman terms. A lot of those disclosures are there on GitHub for technology savvy investors, but not everyone understands them. And then I think separately from that, so one thing is, make sure that, there is better information about what those assets are. And then the other thing is, and separate, I think, is to regulate the activities that are being conducted with that asset. In that sense, Jan mentioned MiCA before. I think this is a step in the right direction. It's comprehensive. It addresses a lot of those activities. And I think also, as mentioned before, here it's very important to work closely together. Global coordination and cooperation is very important, and is more important in other areas because this market is sort of global by nature.
Thank you, Montserrat. And I wanted to turn now to Esmond. Montserrat made an interesting distinction on stable coins between those that are like deposits and like investments. And as a big ICSD, I wondered whether that's something you would agree with in your from a Euroclear's perspective, and also whether you would agree with how Benedicte and Jan had essentially summarized the distinction between payments and securities like digital assets, and therefore one being under central banks and one being under security markets regulators. Esmond?
Well, essentially, thank you. Good afternoon, everybody. Thank you for your question, Mark. I agree to all what have been said. That essentially, I think there could be two types of digital assets. One is payment related. The other are the more or less like a securities related. If I make a further refinement on that, is that as what we have discussed about the stable coins, some are likely to be very much akin to investment products, whereas other stable coins are very much similar to, say, a payment vehicle, a means of payment. Now, if I may draw a sort of distinction, is that there's if there is a fixed nominal value, it is more or less like a payment instrument. If it hasn't got a fixed nominal value, it is more akin to an investment product. I think we can work along this distinction. Now, for those stable coins that are with a certainty of nominal value, I would say that it is more similar to a payment instrument, a means of payment. For stable coins that has a sort of investment value, in the sense that the fixed nominal value, the nominal value is not actually fixed. You could increase or decrease, then it is more or less like an investment product, could be regarded as securities. I think we would work along such distinction in order to decide whether it should become under the securities regulations for the investment products, or should it be under the central bank payments system regulations as a means of payment. Well, for CBDC, which is issued by the central bank, that is another issue or another category. It is a high power money, similar to paper currency. In terms of the, say, wholesale payment, then it could be a new form of payment infrastructure. So I think that's the sort of thing that we have been in mind. And of course, if it is akin to securities, the ICSD would have the interest to run the clearing settlement system for those securities, whether you call it digital assets or you call it, say, securities tokens or stable coins with a implication on investment. Then I think we will regard them as securities.
Okay, thanks, Esmond. And maybe I'd like to go back to Jan and Benedicte on this, because obviously we made a distinction initially between sort of crypto assets and stable coins, and crypto sort of being more like securities or the security regulators, stable coins more in the camp of central banks. But it seems that Montserrat and Esmond are making this distinction within stable coins between those that are more deposit-like and those that are more investment. And so, Jan, would you agree with that distinction and how they then should be regulated?
Yeah, so I think indeed, Esmond made here a key point on let's say whether you have a fixed nominal value referring to the official currency in a way, or in a single fixed currency, and I think that's also a bit the approach we've taken in MiCA. That the moment basically you are referencing indeed a single currency. And then we, let's say, indeed are assuming that the main use will be for payment purposes. So we, let's say, then would indeed also integrate those tokens into the e-money, let's say, regulation and regime which we have in Europe, which is clearly for payment instruments in a way. If, on the other hand, indeed, you have an asset which is backed, let's say, by, for example, multiple currencies or other kind of reference values, then indeed, I think it is still important if you make a promise of backing that promise is underpinned by something. But then, indeed, I think we would be much more nervous if these kind of instruments would then be widely used for payment purposes. So I think the way we are kind of working there is indeed to let's say, to have rules in place, indeed, to make sure that your backing is kind of your promise is underpinned by a backing, and we would have rules in place indeed to for investor disclosure and other matters. But the moment there would start to be an objective wide use for payments, basically, I think there could be then some limits built into that. And other matters. Now, I mean, we have to say one thing: the market is not always. I mean, I think we can here conceptually agree the market is not always developing exactly the same situation direction. I mean, we know that let's say, and as a citizen, you go to some supermarkets or some online venues where you can pay with Bitcoin. Basically, that's at least the claim which is being made. So I think we also need to, let's say, continue watching the reality and the market reality, and see how indeed regulators can respond and react to that.
Yeah, I think that's a fair point, Jan. And I wanted to turn over to Benedicte now to get her opinion on that. And then Benedicte, maybe staying with you, when you talked about over the last 4 or 5 months, more consistency coming in, you know, in this space, but there's still a lot of fragmentation, and I wouldn't mind getting your sense, you know, being obviously a representative of a large global body, what you think needs to happen to effectively you know, make things more consistent across the border from country to country, from you know within the type of assets, and then you know across the jurisdictions.
Yeah, so maybe let's first on the first question on these stable coins. So yes, when I said stable coins, I meant the fully backed one, the typically the 1-for-1 versus a specific currency. As to the others, yes, people could look at you know, securities regulation, but not every securities regulation can capture a product where the underliers are not securities. And for some of these tokens, the underliers, even those algorithmic stable coins, the underliers are not necessarily, they're not securities. So anyway, it will take some evolution on that end. But for practical purposes, when I said that on a more positive note, we saw stable coins being more clearly understood to be potential payment instruments, I was referring to typically the 1-for-1 backed stable coins, or those linked to the clear value of a standing central bank currency. Yeah. And then secondly, on the fragmentation, I want to go back to something that Jan said, is we have to keep in mind securities regulation is not global. I mean, that's exactly actually why I said I think it's problematic to regulate a payment instrument under securities regulation, because it would mean you need to deal with jurisdiction-specific approval processes. So typically, an investment instrument needs to be approved within the market. And Mark, you're very familiar with Hong Kong. So anything a retail investor might want to invest in needs specific approval for that specific product, right? So slightly different if you're institutional or if it's a smaller group of investors. But if it's to the public, which crypto assets are in some, then it requires case-by-case approvals, right? So I think securities regulation is not global. It's become more global, yes, over the last 20 years, but it's still not global. Even if you look at IOSCO's membership, not every country on earth is a member of IOSCO, right? And so what that means is that if you're inversely talking about Will there be still place to hide, so to say, for crypto players who don't want to be regulated? I would think so, yes. So what I'm saying is, on the positive end there, is that for markets that are more developed, they have, let's say, drawn some lines and then put certain aspects under securities regulation. And then where they have such securities regulation, it's quite consistent. The problem is there are many places on earth where there's no securities regulation, and with a very new product, there's probably still places to hide. And that's what de facto has been happening to a certain extent with this, what I used to call, back then when I was in the industry, island hopping. It's literally they move from island to island. I would say, though, because on the other hand of regulators, some regulators now opening the door, you see also that some of these island hoppers actually incidentally are now settling in a specific place where they can get a license. So that's what I also meant with slightly positive, because maybe we've come to the point where even those setups have understood that they can't forever go unregulated, right? But there will always be the smaller players or more novel players, or maybe completely decentralized players who will do efforts to not be regulated. But it seems like the real big ones now are looking for places where they can get a license.
Yeah, I think that makes a lot of sense, and like your point about island hopping, Benedicte, and also the fact that, as you say, securities market regulation is jurisdiction by jurisdiction. But maybe, Jan, turning over to you. I mean, obviously the EU is a bit unique in this respect because you have 27 members, and you pull that all together through the EU mechanisms. I mean, would you agree with that characterization with Benedicte? And what about, and Benedicte touched on IOSCO. I mean, what is the role you think IOSCO could play in creating, more consistency or harmonization across all these asset classes, at least the ones under the securities markets regulators?
I fully and wholeheartedly agree on the role of IOSCO, the CPMI for the payment aspect, and the FSB a bit to keep the overall, let's say, coherency and consistency in the system. So I think there's a lot of work which has been done, but also a lot of work still kind of ongoing and which needs to be done. I think on stable coins, maybe one is a bit more ahead because there was a kind of an earlier, let's say, regulatory focus and also kind of public policy focus on them. I think the work on crypto assets in general terms has maybe, let's say, had less kind of, if you want, political headline attention, and in that sense also less push, of course, to kind of to coordinate and converge. But I think this is now happening because the markets are clearly growing. And that's a very important work. I think what is important there is to focus on the, let's say, the outcomes, because we will not, because of the different starting points in terms of the existing securities regulatory systems, and also to a lesser extent, but still in payments, we will never get exactly the same, let's say, systems, but the outcomes need to be actually comparable. Yeah, I think that's a bit the main point. I think, Mark, sorry, I forgot your first point. You asked something.
No, I just think that I was just asking about IOSCO and yeah. Whether with the role that
no, indeed. So that's absolutely that's true. I mean, in the EU, indeed, as you say, that's sorry. You were
the EU was the first point, actually.
Yeah, kind of a special situation. Yeah. I can just confirm in general terms that was maybe also the tendency Benedicte set out, indeed, that large players are searching actually regulation, and they're not necessarily searching, let's say, low-level regulation. So, I mean, I think Mika, the proposals we've made are kind of quite demanding in some areas. We know that, and also quite challenging. But I think overall we have not seen, let's say, now a strong pushback to say, well, if Mika comes, basically people will leave the EU, or that's normally the kind of talk you sometimes get from people. It's not always true, but we haven't heard that at all on Mika, basically. I mean, at least not to a large scale, because I think people are interested in kind of solid, high-level, high-standard regulation. So in that sense, I confirm very much Benedicte's point here.
Yeah, Jan, okay, thanks. And maybe to Montserrat, over to you. I mean, as a market perspective, I mean, we've heard, what Benedicte and Jan have said, that, some, instead of this island hopping going on, certainly some providers are looking for regulation, and then we've also seen that maybe the market's looking for regulation. I mean, what is your kind of view on that? And what is your view on fragmentation? I mean, quite often we find in the industry, the regulators obviously are having to deal with their own concerns within their own individual jurisdictions, but we always are quite often calling for more consistency and standardization across jurisdictions, so that we can it makes it easier for investors and easier for participants in the market to kind of go in and out of different markets. I mean, would you say the same here, that this is something that the market would like to see more of?
Yeah, absolutely. I think every single player out there, or at least the ones that want to, comply with the rules, are looking for legal certainty and regulatory clarity. I think that is quite evident right now. And I think also we need to look at, it is true that we have some regimes that are already in place that they're going to be difficult to change. But I think we need to look at, what are the things that are not working today and how could they work better. So, for example, and I'm moving now to CBDC, a lot of people think that CBDC is going to be the answer to a lot of problems, including, cross-border flows, making them more efficient and faster. But I think we need to take a step back and think about why aren't they like that today? What are the root causes of that problem? Because I think that's very important that we look at that as we look forward and we think about what to put in place or how to fix those things or how to make them better. So if you look at that, and you look at the actual evidence of the data, a lot of those issues are related to two things. One is difference in message standards. The other one is differences in KYC requirements. So to the extent that we can harmonize that, there are lots of things that are going to get solved. So for the markets that are new, I think it's going to be important, like this one, as I mentioned before, it is global in nature. So we still don't have sort of common terminology and definitions which, become relevant. So to the extent that regulators can work together and agree on some of those basic things, I think would be quite relevant and important for the market. Then I think, come up with minimum principles, like similar to the Financial Action Task Force with AML that everyone agrees to. They don't have to be very, developed, I think more kind of basic principles that they can be acted on and implemented. Then agree on what are the common risks and how to address them, sort of like regulatory building blocks that could also be implemented, kind of perhaps in slightly different ways, but the main principles are there and they are common. And then, as I said before, very important to agree on standards, particularly for cross-border markets. We cannot have different jurisdictions implementing things in different ways. This is costly in many ways and not just in terms of monetary costs.
So maybe just saying one follow-up question on that, and actually just a reminder to everyone, please use the Q&A question and answer to ask any questions, and then I'll see later to direct them to the relevant panelists. But sorry, I've just lost track of my question. So maybe I'll come back to you. But Esmond, Montserrat said basically, we want there needs to be more work on definitions, principles, regulatory building blocks, and standards. I mean, is that something that you would agree with at Euroclear as well?
Sure. There's all these are very important, and I think the CPMI in BIS and IASCO, they have got a joint steering group. Some sort of coordination work can be done between these two committees. I mentioned this because although we separate the digital assets into two types, one is payment related, the other is investment related, but actually they are interrelated. There are connections between the two. Take an example, the stable coins and also the CBDC, central bank digital currency. Both of them could be used for payment purposes. Now, to the extent that they are used for wholesale payment in the capital markets, they potentially can shorten the settlement cycle from T+2, which is the conventional one, to T+0. Now, this is very important. For CBDC issued by the central bank can make good use of the CBDC to do market surveillance. So instead of surveilling on the investment products, they can make use of the CBDC for market surveillance on the other side, which would also help. And the oncoming of the security tokens may to some extent become alternative investment to bonds and shares. Now, if the security tokens are based on some projects, could be physical projects, could be some underlying bonds and shares, then its nature is quite different from shares and bonds. Now, if it is the underlying asset is a project or some property, for example, then the tokens are actually riding on the financial return of the underlying project. They are not shares because the ownership of the company would not be diluted. Or also, they are not bonds because the repayment of the principal and the coupon payments are not obligatory. They pay dividends on the basis of the financial return of the project. Now, all these are possibly become alternative assets other than bonds and shares. So I think all these should be, say, looked at on a holistic basis. And that is why I think, although we make a categorical distinction between payment vehicles and investment-related digital assets, but actually the two are quite interrelated. And I suggest that the joint steering group between the CPMI and the IASCO can coordinate and work together to see what sort of, core principles that these are assets and also the financial market infrastructure, the exchanges, clearing and settling these digital assets should observe. Thank you.
Thank you, Esmond. And Montserrat, now I remember my question, which Esmond started answering a bit, was you mentioned common definitions, principles, regulatory building blocks, etc., standards. I mean, do you see CPMI, IASCO as one of the tools to be able to get you there, or would you expect, or are there other vehicles at the global level that can do this work as well?
Well, I think you currently have the FSB on global stablecoins. You have CPMI, IOSCO looking at the application of PFMIs to systemic stablecoins as well. And I think we have seen a report recently from IOSCO on the DeFi. So, I think, sort of the three of them, working together. Because I do also believe that some of their decisions are sort of interrelated. So it's not that there is nothing to sort of build on. I think they are working on some of those topics, but I think also working a little bit more on sort of the basics, would also benefit the industry.
Thanks, Montserrat. Esmond, I wanted to come back to you, and you started touching on this a little bit in your last answer. And one thing we haven't really touched on a lot in this panel so far has been the financial stability implications of the use of all these various different types of digital assets. And I wouldn't mind getting your view on that. I know you're also an ex-central banker, and you've looked at this in other asset classes when you've been at the MA. So yeah, I wouldn't mind getting your thoughts on the financial stability aspects, which I think is something that it's been written about a lot and talked about a lot, and a lot of concern around these markets for financial stability reasons.
Well, on the financial stability, I'm a bit more optimistic with the oncoming of the digital assets, such as the security tokens. Now, at the sort of security tokens that I described earlier, based on the financial return of a project, is more or less like if project financing investment trusts. It's quite similar to the more conventional concept of a collective investment scheme, rather than issuing bonds. Now, we all now know that there has been a property companies debt crisis in China for the time being. Now, let's imagine if we went back 10 years earlier, And these property companies, instead of issuing bonds for their developments, they issue these tokens, project financing investment trust, so as to raise capital for their investment in the last 10 years. Chances are they may grow a bit slower because it's not that easy to raise money as compared to issuing bonds, say, in the last 10 years or so. But on the other hand, they may be relieved of this current property debt crisis, simply because they are raising money by an alternative means, which is more or less like a collective investment scheme instead of issuing bonds or say floating debt in the bond market. So this could be an alternative way of fundraising, which could, in the longer term, potentially bring more financial stability rather than less.
So that's an interesting thought. Is that, you know, a lot's been talked about, you know, these instruments possibly causing less, you know, financial stability or instability, where you're saying actually security tokens potentially could be, you know, could actually improve financial stability. Maybe over to you, Jan, and just getting your thoughts on the financial stability implications of these various digital assets, and maybe, you know, your thoughts on where you would see the biggest concerns at the moment.
You know, I mean, I agree very much that I mean, this space has the potential actually to improve the stability of the system if it is done properly. And I mean, I think also, as mentioned, the let's say the perspective to shorten the settlement cycle. I mean, if that was were to be indeed proving to be happening, that would be a huge improvement actually for getting the system, getting more stability into the system. We've now here just put up a DLT pilot in Europe to test these things. So I mean, I think the jury is still out whether it can really work on a larger scale, but it's certainly something to be explored. So on the other hand, of course, I think we need to watch the broader markets actually, also for let's say financial stability concerns, and they are clearly increasing ones. I mean, I think on the payment side, on the stablecoin side, the debate is clear, and I think we know now by now. I mean, they're the traditional matters linked to payment systems, and I think also there indeed the distribution of roles. That's maybe something which is where the jury is still a bit out. In which areas will in the end then public tokens, so CBDCs, be the necessary best solution, because otherwise any private solution would raise concerns. I mean, for example, I personally think when it's about security settlement in larger scale, I think that's probably something where central bank money is probably, I mean, there are good arguments for it to be used. Just to give one obvious example, and where that's maybe let's say not indispensable. And I think then the third aspect is about the general market development and the general kind of financial stability implications of crypto asset markets development. I mean, right now, I think that's also what's the assessment of the FSB. The links between, of course, the crypto markets and the financial system are not yet very strong. So I think there's not yet a big concern there, but those links are, of course, increasing. And so if not properly regulated, I think we could so soon see indeed concerns rising, because very simple, very fundamental issues such as clear information, transparency, etc., are very often not guaranteed in these markets. And that means that if things are actually, I mean, if there are kind of shocks, then it's very difficult to see whether things suddenly accelerate, and then you would also have kind of knock-on effects on kind of traditional securities markets. So I think there indeed it is important now that let's say we're getting quickly to a situation as the markets are growing, that a substantial part of this is indeed moved into the regulatory and supervisory space, so that then indeed also any kind of shocks or adverse developments can be properly contained.
Thanks, Jan. And Benedicte, maybe back to you on the same question. I mean, we've heard from Jan saying, as Esmond said, there could be a lot of benefits for financial stability, but there are a few concerns. You know, one around crypto assets, around a bit around, you know, where you know, CBDCs maybe or central bank money may be more stable, the use of it than some of these other assets. But it would just be interesting to get your view on that. Benedict?
It's a difficult question because all these things are happening at the same time, right? So the problem is there isn't CBDC yet. So we talk about it as if it exists, but the reality is, other than in selected countries, it doesn't exist yet. Secondly, I think Montserrat referred to the fact that let's say CBDC might not be fully interoperable. And that is correct. A retail CBDC in one country may not look the same as a retail CBDC in another country. And while it would be ideal to have standards, I would note, for example, that RTGS systems are also different from country to country. Several countries are many now FPS systems, but not all of them have them. So it's also not unusual for that type of national infrastructure to actually be not necessarily internationally interoperable. So now to avoid that issue, we also have in the BIS Innovation Hub specifically these projects where we're working together on cross-border CBDC infrastructures. And then specifically, the key point is to make that interoperable. But again, that's not so simple either because of some of the complications around other forms of regulation, such as AML and CTF and sanctions controls. They need to be very much payment-based. So it's not a role that a central bank would be able to execute. So it needs to rely on the banks to execute that. And I suspect quite some cost in the system is actually linked to that. I mean, some of our research demonstrated that, though not all cost, but quite some of the cost is linked to that. So in some CBDC, it's not yet here. It's not yet here on a globally interoperable perspective. And as such, you could nearly say that the risks of CBDC are currently quite low. Now, on the other hand, the risks of crypto obviously are no longer low. And I think that's what the FSB had observed in their latest research. I think their concerns are largely around also probably some of the leverage that is in the system. And because the system is now operating very much in isolated fashion without large participation from the banking system, the contagion effect is actually pretty minor, both because the system is actually compared to the financial system still very small, and secondly because you can't freely flow between both. But if you can freely float between both, then obviously you need the exact same financial stability controls that we have for the rest of the banking system. So maybe that's where, as Montserrat mentioned, that's where we're back at same risk, same regulation.
Okay, thanks, Benedicte. And maybe Montserrat, over to yourself. I mean, do you have any further views on, from the market point of view, where you would see the financial stability risks and where you could see the benefits actually as well? I mean, Esmond obviously touched on security tokens as being something that could provide a benefit.
Yeah, well, at JP Morgan, we have been working with blockchain for a very long time now. We have used it for a number of use cases. So, for example, one of them, we have a product called Ying, basically, solves this issue of, having different requirements in different places, for payments purposes. We have also used blockchain to create an intraday repo market. So we definitely see the benefits, of using the technology in ways that, we didn't have before. Going forward, I think we also need some sort of minimum principles for those emerging markets. I'm thinking, for example, of DeFi. So, the risks and exposures are not sort of grown too big before something is being done. And also, we think that, the regulators need to work together. I understand it's not an easy task to do, but it's kind of important to join forces and to agree on what needs to be done in some of those areas. So a lot of opportunity, but at the same time, sort of new risks that would need to be addressed
Okay, Montserrat,
maybe
staying with you.
I would say something else. I think it's also important as we think of new regulation that we do not create sort of avenues to do regulatory arbitrage and create loopholes. So, some players are able to conduct some of those activities bypassing the rules. So, regulatory coordination, but also like avoidance of regulatory arbitrage would be very important.
No, I think it's a good point. I mean, it's not just coordination, but arbitrage, avoiding arbitrage as well. I mean, maybe staying with you, one thing we haven't really touched a lot on so far is how critical is cross data flows for financial services for digital asset transactions. And I wouldn't mind getting your thoughts on that. And just again, a reminder, if people have other questions, we still have about 20 minutes left. So please feel free to put them in the Q&A box.
Yeah, I think that is actually critical for our global service offering, for our due diligence, cybersecurity operations, and the ability to transmit data from one jurisdiction to another, basically helps financial institutions to provide core products and services to customers, including executing buy and sell orders in global markets. They also help manage risk on a holistic basis across affiliates and borders, and also comply with financial regulatory requirements in various jurisdictions, including KYC, AML. And finally, it also helps to monitor and defend global networks from malicious cyber attacks. So it is quite important to do that. And, I think regulators need also to keep that in mind as they think about, regulation and limit of data flows across borders. Definitely, the current trends have effects and far-reaching effects on the financial sector that is global and interconnected in nature. Because I think we shouldn't forget that, the operations are interconnected. So some changes in one place are going to affect things somewhere else. So data localization can bring side effects for the financial system and the overall economy. They may increase IT and data complexity, undermine risk management, cybersecurity, and anti-money laundering practices of financial institutions, as well as reducing access to financial services and markets in some countries.
Thanks, Montserrat. Maybe turning to you, Benedicte, on the same question around data flows. I mean, you've heard from Montserrat, her views from the industry perspective. I mean, is that something you would share from being in a global institution?
So I think on the data side, public blockchains have these public addresses, right? So personally, I think they're much more traceable than the traditional financial sector. So for everybody's context, and I think quite some know, I spent a long time of my career in compliance, and a big chunk of compliance is AML, CTF, and sanctions compliance. And the systems are they've improved over those 20 years of my career for sure. But every single bank is plagued by an enormous amount of false positives. And what they then need to do, they need to tune the system to reduce the amount of false positives. And while you do that, while you reduce your false positives, you actually have a risk that some of the transactions that are actually positives get now classified as false positives. So I would say for about 20 years of my life, it's been a game to try and get to the right information. Also, I don't know, whether you're aware, but let's say a payment system like SWIFT is not monitoring these data. The data are being passed, but these data are not being real-time AI monitored, for example. So the monitoring role is played by the banks. Now, if you compare that to crypto, then crypto has the public address already right available, right? So any of these systems that are now building crypto monitoring are doing that with the public address. And then just keep in mind that that can go back anywhere in the past, right? So these crypto monitoring mechanisms have now grown up. I've seen them growing up for 5 years, and they can just go backwards. They can, you cannot do that in finance. Try it. The only way you can do it is by bilateral and multilateral collaboration across jurisdictions, which is extremely rare to do. It's only done in cases where there is actual suspicion. Now, for crypto, it's for everything. Everything goes through the system, right? So the missing link in crypto is clearly that the identity is not linked to that public address, right? But now with the, let's say, the continued request by FATF to have the travel rule, it means that any of the big players, those same big players who are now looking for regulation anyway, they would have not only that public address, but they also know the identity. So you combine these two, it's obviously a lot quicker to get this information than you can get it in the current financial sector. And I think in the context, for example, of right now what's happened with Russia, I don't know whether you saw, but one of the leading exchanges was able overnight to block 26,000 accounts. Honestly, in my history, I haven't seen any traditional player blocking 26,000 accounts overnight. Now, there probably is another 100,000 that are malicious, right? So I'm not here to say that there isn't bad activity going on, but I'm saying it's pretty impressive when you can block 26,000 accounts. The other thing is, as you can go backwards in this activity, you can also link it, for example, to jurisdictional issues, such as, for example, Russia. Or you could link it, for example, to other issues, like, for example, the use of mixers. And you could start considering certain addresses to be tainted. Also, as you know, the addresses can be added to the OFAC list, in which case they can be automatically blocked. And stable coins in general can nearly be remote control frozen in things that in fashions that have never been possible in traditional finance. So one thing I always find really rather interesting is that traditional finance seems to think that crypto finance is dangerous and non-transparent. I think it's actually potentially much more transparent. But the inverse is also true. Crypto walks around saying it's privacy protected, anonymous, and all of it. Well, it won't be, because as soon as a travel rule is built over it, as I said, I think it's potentially more transparent. So I think the judge is out there if it's more or not. But from what I can tell, I think more data, because it's a public blockchain, so more data are publicly available. That also means that more people can publicly build monitoring tools. So let's now take SWIFT, for example. The SWIFT data are not public. They're not public data. So no one can build a public tool over that, right? No one can become, like the crypto guys are doing, a tool over that. You can't do it. You have to have the bank data, or you have to have access to the SWIFT data, which you can only get access through the proper means, like a subpoena, for example. So in sum, I'm a little bit on the fence on this one. I still think the judge is completely out there. And as I said, I watch things like the latest development with a lot of interest from exactly that perspective, like who's able to find the offenders faster. Right, and those are likely the more transparent one, because they can find them faster.
I think that's a really good point, and that it is a public ledger, and you can go back and follow every transaction all the way, and you can't do that in traditional finance. I mean, I know in past experience years ago when I was at ASIFMA in Europe, and I was working in the fixed income space with the debt management offices. I mean, they had to come to us as the dealers to kind of create a common template, which was essentially an Excel spreadsheet that would show them every month what each of these dealers were trading their government bonds. They had no idea who was actually even holding their government bonds. We had to kind of put this together, and even then, it was just really the most recent transactions. So they had an idea that hedge funds were buying and central banks were selling, but they still had no really idea at the end of the day who was actually who owned the underlying government bonds. So you're right. I mean, with digital assets, these transactions should be be able to track it almost instantaneously. So yeah, and I mean, your thoughts on that, and also just the general need for data to be able to flow cross border for the sake of these of digital assets.
Look, I think Benedicte has given a perfect overview of the both the challenges and the many also opportunities in this space. I would very much share her characterization of this, and I think you have much more practical experience on that. So I think let's say from the regulatory perspective, of course, one point, and that is something which is true in jurisdictions and across jurisdictions, is indeed how does all of this square with privacy laws, basically. I think that is a discussion which is also still at the start. I think not every type of DLT is the same there, and also I think in terms of the kind of the benefits and disadvantages which Benedicte mentioned, of course, permissioned and private blockchains basically have a quite different feature than completely public ones. So probably also the need to go a bit more granular here, but that's certainly generally discussion which still needs to be had very much. And I know the data protection authorities are also looking at that. Yes, and in that sense, of course, in the broader context, it is important that data continues to flow indeed freely in this area, also with respect to data protection laws. So I think that's something we are working on. You know that now finally the EU has put up a new agreement with the US indeed on data transfers. I think just back in December we concluded an agreement with Korea, and then before with Japan. So I think we are actively working towards this. Because it's important. Yes, it's important to ensure the free flow of data, but it's also important that people that you don't completely disregard the privacy concerns people have in this area, because otherwise, sooner or later, it will also. I mean, there will be that may also be a showstopper. I mean, when the European Central Bank actually consulted on the digital euro, the number one issue which people kind of mentioned, and the number one concern they had was basically what about my data, basically, where will it go? And also the number one hope is that maybe central banks would be more kind of limitative on that than private actors, which also shows that this is a key concern people have in the private markets here. So it is a balance which needs to be found, and I think we're trying to work on it practically, but certainly a lot of work ahead.
Yeah, I think that balance between privacy and free flow of data is an extremely important one and challenging one. And I think that it's also, I think Europe in particular has a very strong ethos on privacy, and maybe Asia a little bit less so, US somewhat maybe in the middle. But it's definitely definitely a balance that needs to be found. And I think that as Benedicte said, I mean, theoretically, you can have a lot of transparency in the digital asset space, which actually makes people nervous because who has access to that information, and that's where the privacy concerns kind of come in. So, Esmond, I want to turn over to you because obviously on data, you're a big ICSD. A lot of this, theoretically at some point could be these assets could be things that you're holding. And I wouldn't mind getting your views on the data, but also on the DLT side, because I know you've got some thoughts there.
Well, on the data, I think we all agree that for the digital assets on this DLT platform, data transparency is far more elaborate than previously. And for the ICSDs, for the time being, we are not operating on a DLT platform. And in future, we may operate a DLT platform because in terms of clearing and settling those digital assets, and also for the custodian of those digital assets, I think it may be as a possibility is that the ICSD may venture into this new area of, say, a DLT platform of say, a dedicated DLT platform for those eligible securities in our system. That's something that we may look forward to in the time to come. On the other hand, I would also like to repeat my earlier point about market surveillance by the central bank. If the central bank digital currency is being used for capital market transactions, as Yen mentioned earlier, that the euro, the digital euro, one of the concerns is the privacy, as well as on the other hand is on this data transparency. But we have to admit that once the digital currency issued by the central bank is used for capital market transactions, could it be settling digital assets or some conventional assets like bonds and shares? Because the central bank has full information about the logistics of its own currency, its own digital currency, then its capability for market surveillance definitely would be very much enhanced. Say, no matter in what way you're looking at it, because instead of the market surveillance targeting at the investment products such as bonds or shares, they can actually look at the logistics of its own currency, its own digital currency, in order to keep track on the movement of the investment flows. I think this is something that we have to recognize. Don't underrate the possibility of, say, the CBDC as a tool to enhance market surveillance by the authorities. I think this is something that we have to live with in the time to come. Thank you.
Thank you, Esmond. And I'm looking at the time. I think we've got a few minutes left. There's one question here, and I'll put it out to the group, and maybe any of you may want to take a crack at it. How should derivatives with crypto assets as the underlying be reported under derivative transaction reporting rules? Should they be treated as commodities, or should they be treated as a distinct asset class? Does anybody want to take a crack at answering that one? I don't know if if we have an answer to that one. Maybe I can go to the next one for Jan or Benedicte. Could robust limits on wallet sizes for CBDC to manage bank deposit disintermediation risk, as mentioned by the ECB, be instituted without a robust digital ID system? And so either Jan or Benedicte or both. Happy for either one of you to take that if you think you can answer.
Yeah, so I think sometimes either I understand or don't understand very well, or the market doesn't understand very well. But the idea of a direct CBDC, which would be a concern around it being competing with deposits, is not being entertained by many central banks. Central banks instead are entertaining two-tier CBDC structures. And what that means is that the bank distributes the CBDC much as it does today with cash through its ATM machines. So this concern around competing with deposits actually is not there in the case of a two-tier CBDC approach. And secondly, the KYC issue is also not there because the bank continues playing the role of doing the KYC. So initially there was 3 models being floated. One was the direct CBDC, where supposedly the customer interfaces direct with the central bank, and the central bank would need to do the KYC. Except very few or no markets are entertaining this. Maybe some small ones could eventually do that, but I don't see that happen in large mature markets. The second was the hybrid CBDC, which is where, as said, it's a two-tier system, but the CBDC is still a liability on the central bank. And as said, that doesn't conflict with the deposit issue. And the third one is the indirect CBDC, which is much more akin to a stable coin that is being backed by CBDC. And so if you want to have another look at this kind of a distinction, you can take a look at Project Aurum, which actually sits under my center here in the BIS Innovation Hub Hong Kong Center, and which is also dubbed a study for the e-Hong Kong dollar. and it looks at both two-tier models. So not the direct model, both of the two-tier models. So you don't have a set that conflict with the deposit base, and you also don't have the issue around KYC, because both of them are done by the banking sector. I think it's a common misunderstanding, and it somehow settled itself in the beginning when people refer to direct CBDC, and it hasn't left the system yet. But my feeling is the central banks have moved on. There's very few central banks that have accounts direct from individuals.
No,
maybe just to complement. Sorry,
go ahead, Jan.
No, on the I mean, on the European side, so I'm from the European Commission. We are not a central bank, so we will not issue a digital euro. But indeed, we are working closely with the ECB to see what is the let's say the regulatory framework if the ECB decides actually to issue a digital euro. And I think the ECB, in Benedicte's kind of characterization, is probably when it comes to the retail work, somewhere in this middle scenario, indeed, of a hybrid actually two-tier model. I think we are right now looking exactly, let's say, for what purposes, what kind of data would need to be actually processed by whom, for what purposes. And in a way, it's a bit first you need to decide how, let's say, a CBDC would actually potentially work and who would do what, before you can then, in a way, kind of consider what data does that require. And I mean, I think if you have a discussion on limits, I think that's something which the ECB is having. Of course, that is one of the possible uses. I mean, are there a couple of other uses in a way, the KYC processing and a couple of other ones as well. So I think we are probably not yet quite there to indeed be able to kind of have a kind of very substantiated response to that, because indeed, I think, first of all, you need to look at how a system actually works in detail. And then only you need to kind of work out exactly what falls on the side of the commercial banks and what kind of data processing will they do, and what are I think probably then in such a hybrid model, very limited areas where indeed a central bank may need to have certain data.
Thanks, Jan. Look, I'm going to let everybody just give each of you 2 minutes to kind of close with your closing thoughts, and I wouldn't mind, with your closing thoughts of like, what is something that you're most optimistic about digital assets, and what is something that you're most concerned about? So maybe Jan, sticking with you, I'm sorry I'm putting you on the spot first. The others will have a bit more time to prepare that, but maybe just off the top of your head, I mean, what's something you're most optimistic, you see about the use or otherwise of digital assets, and what is it you're maybe most concerned about? What keeps you up at night about it?
I mean, as I'm more from the regulatory side, I will not kind of then respond on the market side, but also on the regulatory side. I think what I find optimistic and positive is that there is the understanding actually on both sides, on the market side and on the kind of more new market side, the traditional players, and then on the regulatory side, the mutual understanding is growing really exponentially. I think that's something which is still there's still need, and but I think compared to when I started this job 2-3 years ago, I mean, even all the way down to parliamentarians who are not doing technical work, but I think the understanding is really kind of growing exponentially. I think that's in principle a good thing, because I mean, if the various sides don't speak the same language, then that is sometimes a recipe for a clash and problem in a way. So I think that would I would see a positive manner. And then, I mean, we see in terms of the developments, the financial stability concerns, the exact regulatory classification. I mean, we'll sort that out, and it will be a process basically as the market develops. But it's important that this mutual understanding basically grows. So in terms of the biggest risks and challenges, it will be a challenge. I wouldn't say it's a risk, because there's a good spirit, but it will be a challenge to keep indeed a global convergence in this area, because it is so complex. Even that domestically, it involves different supervisors who are one way or the other involved. So the need for coordination is so high that it is going to be a very challenging task on the public supervisory side.
Thanks, Sean. Maybe Esmond, I'll go over to you for the same question. What you're most optimistic about, and what you're most concerned about?
Well, I'm very optimistic about the CBDC usage in the capital market, in the wholesale capital market, and also I'm optimistic about the securities tokens in form of project financing, investment trust could be an alternative asset to bonds and shares. I'm most concerned about the cryptocurrencies like Bitcoin. I think that bubble may burst anytime soon. Thank you.
Okay. And maybe Montserrat, over to you on the same.
From my perspective, you have a lot of developments in the market, like Web3. Lots of people may have heard of it. And some of the dynamics that may entail may lead to the creation of new investment products that DLT would enable. So there will be other alternatives beyond what we have today. So I think that's a positive and an opportunity. And I think that change and that development has just started. There is much more coming up. And in terms of sort of concerns and things that could be done better, I think we need to change also the view of banks as risk enhancers, and also start seeing banks as shock absorbers, and also understand what they bring to the table in terms of their risk management, their processes, their controls. So when we look at this market, do not look at banks as sort of risk enhancers, and also start looking at what are the benefits that the banks provide, because I don't think the market is going away. Investors demand those assets, so we need to think about how are we going to enable the market to work in a way that doesn't compromise consumer protection and financial stability. And in that sense, it's also important to come up with a prudential treatment for those assets. So kind of looking at the opportunities, and also looking at what could make the market a little bit sounder and better.
Thanks, Montserrat. And Benedicte, maybe over to you. We are actually having a little bit of a problem with Kona-san on a technical issue, so he's going to join. Hopefully, you're going to join us any minute now. But yeah, I'll keep you updated on that. But over to you, Benedicte, on the same thing, optimistic and what your big concern is, what keeps you up at night.
Yeah, so generally speaking, I think I implied it in some of the other things I said. I think there's a benefit in competition. So there's risk with competition as well, that people come up with some new things that are a little bit unusual or borderline. And that's going to happen no matter what. But I do think that there is a benefit in competition. So, and let's see, so I see as the positive the competition, okay? And so I'll give you an example. A stable coin can do a payment at a much lower cost than actually some of the standing small value payment infrastructures, right? So even though people are concerned about stable coins, what I find interesting about them is that they can do a payment at a fraction of a percent, really, as opposed to multiple percents and up to 10%. So what I do think is that we need this competition, and eventually, of course, these stable coins will be regulated and all of this, but it is interesting to see quite how large the margin is between a fraction of a percent and the typical 3 to 10%. And I'm not making up 3 to 10% because you know which players I'm referring to, I guess, that perform payments with those type of costs associated with it, low value payments of, let's say, $100 with 3 to 10% cost attached to it. So in sum, there is still a need for competition in that small value payment space. And I think that stable coins offer that competition, but in and of itself, they're not complete yet because A, they are not accounting for FX, and B, they are also not perfect on the AML and CTF side, as we mentioned. But again, it's useful to see competition. Same goes with, as Esmond said, the role of tokenization in general. It will be interesting to see. I actually wrote about this quite a while ago when I was incidentally working with Montserrat at IOSCO. So a long time ago, and we were looking at tokenization and the benefits of instant settlement, and then we went like, well, you know, we talked with institutions, and then people said, well, we don't want to instantly settle because we rather, you know, not instantly settle. And so, you know, these things are so interesting. So we'll need to see that competition play out. Will people vote for that instant settlement, or will they continue taking the view, actually, I don't want to instantly settle? The same thing with that point on anonymity versus and privacy, right? It's very prevalent in CBDC debates to say it must have privacy protection, because obviously, as a regulator, you can't put something out that contradicts privacy. But then on the other hand, as I said, if you overlay with the public address the identity, then it's very transparent. So the question is, where will that pan out, you know, that debate? And then comes the next aspect to competition, is whether in that debate, people then make something that is completely out of the system, which is potentially DeFi, right? So in some, you'll see competition always happen. And ultimately, it's a good thing because it drives us forward. As long as we're not blind to the risks it generates, right? We need to, at the right time, know when the risks are too big and then need to be regulated. And that, I think, brings us back to the beginning of the discussion, that I think a lot is now getting regulated in some form or another.
Well, thank you very much, Benedicte, for that and conclusion on the competition aspect. And look, I think it's been a fascinating conversation. We've covered a lot of ground. I mean, digital assets, I mean, you can have a whole conference on just CBDCs, you know, or any of these assets. So I really appreciate the fact that all of you have been able to kind of cover so much ground. And, you know, I think we talked a lot about at the beginning on, you know, is it more like a security? Or is it more like a payment mechanism? If it's payment mechanism, central bank, security regulators. You know, we talked a lot about the fragmentation and how to bring that together. Concerns around the financial stability, the need for cross data flows. I mean, as I said, we've covered a lot. So I want to thank all the panelists. We're now at a time. So thank you very much for your time today. Highly appreciated.